warm welcome. Today we bring you a special segment live from the Management Institution of MET in Bandra, where Avan will interact with Centrum Wealth Management's Kunj Bansal and several students who will try to understand the dynamics of the stock market in an educational and fun session. Avan, over to you then.
Thanks for that, Kamya. Hi everyone and welcome to BNSN on campus. Being here really brings me back to the good old college days, but it's all the more exciting because today I'm at the Premier B School MET Institute of Management, surrounded by bright and enthusiastic students who have lots of questions. So let's get straight to it because I have with us the guest on the show today, Kunj Bansal. He's the ED-CIO, Centrum Wealth Management, and he'll be helping out the students as well as talking to us about what first-time investors should be doing, what should be one's investment philosophy as well, and what the outlook is on the stock markets. Kunj, first up, great having you with us on the show. Now, I've been interacting with a few of these students and not many of them participate in the stock markets. Even when I was young, I was totally averse to it, told my dad to handle all the finances. So what should be one's investment philosophy for a first-time investor?
Yeah, so I wish there were very simple answer to this complicated question. Very simple investment philosophy, as they say, is buy low, sell high. Unfortunately, none of us practice. We buy in the market, the stock market particularly, or any other market, when we have seen a lot of news flow, a lot of movement, a lot of upward movement, prices having gone up. And at the same time, when the prices are down, the stock market is down, there is a feeling of fear, there is a negative sentiment prevailing around, nobody buys. Let's keep in mind that that's the time actually the sale is going on. And when we can, what do we do when a sale is on in a store? A toothpaste is available 1 for 1 free. Even if we don't need, we simply go and buy it. Now, we don't do it in a stock market. I wonder why. So, as I said, the very simple philosophy is buy low, sell high. Of course, it's very difficult to practice and difficult to implement.
But I think, Kunj, one of the big fears would be, what if I put my money in a stock and things don't turn out as I had anticipated? That fear, of course, is there with everyone. So would there be some strict do's and don'ts that you would advise the young people to follow?
Yeah, lots of do's and don'ts. Unfortunately, it's very difficult to summarize them in a very crisp manner. But first of all, one has to go through the asset allocation of his or her intended portfolio. You cannot possibly put 100% of the portfolio in equities or in any non-fixed income asset class. You have to segregate your portfolio into various asset classes. So you have to segregate first into fixed income asset classes, which is typically debt, and then move on to non-fixed income asset classes, which of course equity is one, very popular, has proved itself to give returns over a period of time, over long periods of time. And then there are other asset classes also, like commodities, like real estate. The newer modes of investment have not yet come into India as popularly as they exist abroad, like wine investing, like art investing. Having said that, once you have decided asset allocation into equity, then obviously one has to be ready that it's a risky asset class, which means the value can go down. And in that case, if value is going down, you don't have to be worried as much. But more importantly, what happens is that when you invest in equity asset class, you have to do a certain amount, or rather more than certain amount of due diligence. Equity investing is not a part-time job or a part-time assignment. Even if it's not that a person cannot or should not do direct equity investing, even if one wants to do, while doing his other job, profession, study or anything, one has to devote a reasonable amount of time in studying the investments that one is making into. In which companies one is investing, in which sectors one is investing, in what kind of market scenario one is investing, with what time frame one is investing. And then one has to, there is a complete, I'm sure a lot of students have studied as a part of their course as to how the financial investing, how the analysis process goes on. And so that's very critical, that let's be very clear that equity is a risk asset class. One cannot expect or get a return in short term. And two, a lot of due diligence has to go in before we invest into equity.
I like that line, that it's not a part-time job. And you know, Kunj, I'm so glad that we have you with us because you've been a market veteran. You've seen 20 years plus of market volatility, different cycles. And I'm sure a lot of the students over here have a lot of questions for you as well. So for those of you who have questions, let's get straight to it. Does anyone have a question for Kunj? Okay, I'm going to start with you.
Good evening, good afternoon actually. My name is Monil, and what I basically wanted to ask is, given that banks are not passing on the full benefits of the 50 basis point rate cut of the RBI to the consumers, is this a good time to invest in the banking stock?
Okay, I expected more simple questions. Kunj, what about the banking sector?
Yeah, sure. So just to relate to all of you, in addition to the background that Avan gave, that 20 years in marketing, let me just tell you that I am a pass out of MMS 94 from NMIMS. So to that extent, have seen 5 cycles of up and down in the market. And it becomes very important to realize that when there is an excessive optimism, like we had 30,000 Sensex in March, and it was looking like there is no risk in the market and just next target is probably 40,000 and 50,000, it doesn't happen that way. There is a risk at all points of time, and similarly when there is an excessive pessimism, it looks like our country is going to close down. It doesn't happen that way. Coming to the banking, one has to segregate the question that you asked. The reason for banks not fully passing on the rate cut announced by RBI are different. One is, of course, the feeling is that despite the rate cut that they have partly passed on, or if they want to fully pass on, given the relatively slower growth in the economy, the demand for funds is not there. So that's one. Secondly, they also have to look at their cost of funds. So if the cost of funds, they are not in a position to bring that down, then they obviously are not in a position to bring down the the rate at which they lend money. Having said that, I don't think we can paint that, okay, because of this should one buy banking sector in general as a whole. In fact, if you look at the recent quarterly numbers, quarterly result season is currently going on. We have had quite disappointing set of numbers from some of the older private sector, or if I may add, regional private sector banks. If you look at some of the last 2, 3, 4 quarter medium to longer term trends, we have seen the sector getting divided into 2, 3 sub-sectors, if I may use that word. Private sector banks, nationalized big private sector banks, have continued to report good numbers. They have been in the position to manage the stress that has been there in the asset quality. Public sector banks, unfortunately not. So the high amount of quality stress, asset quality stress has been coming to that. And then there is another complete space of NBFCs, non-banking financial companies. That's one sector which, out of the full BFSI sector, if we take, has been doing very well. You look at the performance in terms of financial numbers as well as the stock price performance of NBFCs, including housing finance companies. They have been consistently doing well. So coming back to your question, I don't think that one can simply take one factor and say that can it be invested in. There has been performance irrespective of that sector, and there has been non-performance irrespective of that sector. But yes, selective investment opportunities still exist in this sector.
Okay, thanks for that, Kunj. And I have an enthusiastic market participant over here. You've introduced yourself. Tell us a little bit about what you do with the stock markets and what your question is as well.
Sir, I'm new to investing, and I'd like to ask you a question related to intraday trading. Now, sir, under the umbrella of technical analysis, now in case of intraday trading, for example, in an exchange such as Nifty, I would usually wait for around say 10:30 or 11 a.m. for the market to stabilize. But as an opener, when the market opens, what kind of opening strategy, as a base strategy, would you recommend for new investors like me?
Okay, a little bit of a technical question, Kunj.
Yeah, so to clarify, my experience and if I use the word expertise over the last 20 years has been more of buy and hold, medium to long term investing, and to that extent I am not an expert or not a practitioner on technical or a short term trading. Having said that, it purely depends on whatever little interaction I have had with the traders or technical analysts. It purely depends on the kind of position that you want to take, kind of investment horizon, in this case 1 hour, 2 hour, 3 hour, for whatever period market is open you want to take, and also depends on the news flow. If the previous day there has been a news flow in terms of some corporate action, in terms of some mergers and amalgamations, in some terms of some buyout, then you will have to be very quick at to take action at the opening of the market. If not, if it's a steady market, then maybe one can wait for market to stabilize, settle, then take a call that, okay, given the 1 hour of movement that has happened, how do I expect market to pan out during the rest of the day? And then based on that, one can take a call.
Kunj, I have a question as well, and we have been looking at the markets very closely in terms of the FII flows as well that have been coming in, and it's been very contingent on what's been going on globally as well. In light of all of this, there has been a slight pickup that we've seen in the investment flows of late. What is your sense as to how, domestic institutional investors are looking at the market, and whether or not we can see a consistent pickup in the FII flows?
So this is an often talked about phenomena that there are FII flows or there are FII inflows or there are FII outflows. Let me clarify. Over the medium to long term, it is always the intrinsic value of an asset which will lead to the price discovery. So what I mean to say in simple terms, if the company that in which we want to invest into the shares of a company has a strong business model, has been generating good financial numbers along with profitability, cash flows, multiple things, I am sure all of you are aware, then over a period of time its price discovery, its valuation will be identified by the market, and if company has been doing well and continues to do well, its share will in general be on the path rising upwards and give return. In the shorter term, it is always the liquidity which decides. It's a simple economics principle of supply and demand. In a very short term, if there is too much of supply of these stocks, then obviously market will come down because the sellers are more and the buyers are less. Or rather the buyers, seeing the hordes of sellers, run away. That okay, let them finish their selling, then we will come back. And vice versa, if there are more buyers in the shorter term, obviously the demand will be more and the share will move in the short term. But if the fundamentals are not there, over a period of time, that price of that particular asset class, that particular business, that particular company will come down. So having said that, let me also tell you that money has no emotions. It has no family, brothers, sisters. It flows wherever it sees returns. So FIIs are not coming to India because they love India. They simply see the potential of growth that is there in the economy. And as long as they see, subject to their global pressures of asset allocation, of interest rate movements, of currency movements, they may take a break, they may not come for some time, but over a period of time we have seen continued FII flows coming in, and we will continue to see that.
And this is a lot like the tip and advice that you had given earlier also, Kunj, as I was reading your articles, that one shouldn't get emotionally attached to a stock as well. But I'm sure we have some more questions, so let's get straight to it.
So, hello sir. I would like to ask you that recently we have seen US meets, US Fed meets. So definitely they have not increased the interest rates. So, but after the meet, Janet Yellen said that now the rates have not been increased, but then definitely there's going to be coming a hike. So what is your view about that on the Indian equities part?
Okay, a slightly global perspective, Kunj.
Sure. So as you rightly said, all of us, not only in India, in other parts of the world also have been monitoring, following the Fed actions and seeing that there was some expectation interest rates will get hiked, but it didn't happen. And now again it seems to have been postponed. When will it happen? Nobody knows. But if still I were to take a view on when will that happen, it will possibly happen in next calendar year, which means 2016. I don't see it happening in the remaining 2.5 months of this calendar year, for the reasons which Fed itself highlighted, that they don't see as much of recovery in the US economy itself, and they have also now started looking at global volatility, global economic factors, which earlier they were not looking at. If we extend the question to answer that, okay, as and when the interest rate hike happens, what will be the impact on India, the Indian stock market or the Indian funds flow? Yes, in the short term, such reasonably big developments do have an impact in terms of funds flow directions changing. So if we have interest rate getting increased in the US market, we will possibly see some movement of FII flows from all the markets. It's not only that they'll be withdrawing from India into possibly the US, and as a result we might see some outflows. Let me also put a rider there, that while it's very easy to talk it on a general basis, the money that comes to India is, first of all, a large part of it is dedicated to the emerging markets or dedicated to India itself. So to that extent, saying that a significant part of that money will go into the US because it's a developed market, possibly no. As I said, it is dedicated to emerging markets, so it possibly no. Secondly, it's dedicated to the equity asset class. So again, will it go into fixed income asset class? The answer is no. But yes, their short-term movements do happen, and as a result short-term volatility might be there, although this particular event or news flow or trigger, whatever we call it, has been milked enough, or rather more than enough. We have almost, I think, more than a year of this news flow happening, and on the same news flow market will react once, twice, maybe thrice, not more than that.
Okay, that was a very interesting perspective on how one should look at the global markets. But I'll tell you what, we'll slip into a quick break. Do come right back. We have our students here waiting to ask lots more questions to Kunj. Welcome back, still tuned into BNSN on campus, and we're coming to you from the MET Institution of Management, which is the Premier B School. And a lot of the backbenchers have been pretty quiet. I know I was a bit of a backbencher in college, but I saw them asking a few questions, so why don't you tell us what you have to ask?
Good morning, sir. We've been seeing many IPOs coming up. So as a first-time investor or as a retail investor, how could we decide in which kind of IPO or which company which should we invest in, sir?
Yep, Kunj, the primary markets have been very active. What's the advice?
So I don't think there is any difference in the way one will analyze for investing in a company which is already listed or a company which is coming in for an IPO. There is a standard methodology of looking at the financial numbers, looking at the long-term track record, looking at the expected growth in the future, and of course coupling it with the valuation expectation. The same thing will apply to the IPO also. So I don't think there will be any significant difference between analyzing, as I said, while investing in a company which is already listed or a company which is coming in for IPO. One or two points of differences is that what is the likelihood of allotment if an issue is really attractive in terms of company's performance and its pricing or the valuation at which it is being offered. So generally we have seen a significant amount of oversubscription happens. Now, does it make sense in applying such companies, although these days you don't block money because you apply through ASBA and all that, but one generally doesn't get allotment. So I think in my view instead the analysis should extend to, okay, at what price range when it gets listed am I comfortable? So that's one thing. Second thing is that in case of existing listed companies, you generally have track record available in terms of not only financials, but in terms of promoters' track record of corporate governance, ethical policies, minority shareholder friendliness, and such other qualitative things, non-objective, non-number oriented thing. That will be difficult to find out, might be difficult in general in case of a new company coming in for an IPO. So that's one additional thing which will have to be brought in while analyzing before investing into an IPO.
Let's get in some more questions. And do the ladies have any questions for Kunj and any stock specific? Okay.
Hello sir, my question is, being a first time investor, what are the major things that one should analyze and then decide to invest in a stock, and what would be the best time or the correct price to enter into the market?
So I wish I had an answer to all such questions, and that too a capability to tell you that in a short period of time. As I said earlier, I have been in the market for 21 years and still looking for answers to these questions. Having said that, a first time investor, first of all, we should be very clear, aware, I am sure all of us are, that equity is a risky asset class. And to that extent, we are investing in a risky asset class. The investment that we make, especially in shorter term, can go down, can have a negative value. Secondly, all the more so if proper amount of due diligence has not been done before investing into any particular stock or a company. So obviously that brings us to the fact that we have to do a detailed due diligence before investing into any equity. I'm sure all of you have studied as a part of your course. There are multiple things to look at. The expected growth rate of the company in terms of top line, along with that the profitability. Of course there should be cash flows. That depends on the business. If you are looking at a high capital requiring business, there may not be cash flows in the beginning. And then there are some subjective factors. So one has to look at the track record of the management, track record of the promoters, corporate governance, their minority shareholder friendliness. So multiple things go into it. As I said, over a period of time one gains this expertise and experience and then able to invest. What is the right time to invest? There is no right time and there is no wrong time. Ideally, buy low, sell high is what they say. But does it mean that one should wait for a correction infinitely before investing into a share? No. There are multiple examples available in the market that if a company continues to do well, it's very difficult to get its share at a price at which one would ideally want to buy. Of course, there are events like blue swan kind of events happen when the markets come down sharply, and there could be opportunities to buy those shares at such times at a lower price or a lower valuation. But one possibly cannot wait. What one can do is, if one has analyzed, one has got convinced, one is comfortable with the valuation, invest. If there comes an opportunity because of market correction, because of some global events, because of a short-term problem with the company's performance and price comes down, then one adds more to it.
I think, Kunj, everyone is prodding you on that question because they want to go home absolutely convinced to put their money into the stock markets, and hopefully you'll be helping them to do that. But some questions from here.
So just now you spoke about the entry point. I would like to ask, what should be the exit point as well? As in, when should we sell our shares, thinking that the price of the company won't go beyond that point? So how can we predict that exit point as well?
That's an interesting question, Kunj. What do you have to say?
Yeah, sure. So in terms of exit, although if we read big global veterans, global investors, they have said that you should invest in a company forever. Maybe not necessarily so, and to that extent I am digressing from that, not that I am anywhere near them or can place myself in line with those, but I think over a period of time, as we all have seen, what has happened is that the pace of change in the economies has significantly increased. The factors that drive the stock market, that drives the valuations have multiplied so many. So maybe 20 years ago it was relatively simpler to analyze. There were no global connectivity of the economies. There was not as much of a currency related interaction amongst various countries. There was probably not as much of a fixed income related interaction amongst various countries, fixed income asset classes. Now all those things have come, the global trades have come, the import export have significantly gone up, the factors that affect China immediately affect the other global markets. So to that extent, saying that one can remain invested forever in a company, probably no. Yes, what should be the right time to exit? Again, a difficult question, but obviously one has to keep looking at the valuation. Given the way the business is panning out, has at a particular point of time valuation become expensive, and there is no fixed definition of expensive or cheap valuation, that one has to decide based on his comfort or based on multiple factors which apply at a particular point of time. So one, if valuation has become expensive, one has to take a call to exit. Alternatively, we tend to fall in love with our investments, that no, I have analyzed this company, how can I go wrong? But no, if the stock price has been going down, if the company has not been performing in line with the expectations, then one has to be ruthless, one has to be emotionless, we can't get attached to a stock, and one has to take a call to exit in case of loss also. So very simply put, although as I said it's a difficult question to answer, but these are the two reasons. Of course there could be yet another reason. Third reason is that you have a limited set of investment or rather limited money available to you, and here comes a very interesting investment opportunity which you feel will do far better than any of your existing investments, and that may also trigger exit from one or two or more of your existing investments, that since a new opportunity that has come is likely to give you far higher returns in percentage terms, obviously you should take call on one of your existing investments.
So only marrying the life partner, not the stock, would be the analysis. I believe you had a question as well.
A very good morning, sir. I would like to ask about, when we are investing in a mid-cap company, can the promoters' shareholding in the equity help us decide should we invest or not?
Kunj, what's the call in terms of how closely one should look at the management?
So, very important part, besides looking at the numbers which are at least historical numbers easily available, one can look at them, analyze them. One can probably with some certainty project the expected numbers also that are likely to pan out. But there are a lot of subjective factors of which management is very important. Now, on your question of management shareholding, there are multiple ways to look at it. So I don't know if you are asking that if the shareholding is low for the management, for the promoter group, should one invest, should one have the comfort? Or if the shareholding of the promoter group is high, then only should one have comfort. I don't think one can answer that in any fixed manner. In fact, the current regulations require that whenever a company goes in for a float, goes in for a public offering, it has to divest a certain minimum percentage of shareholding, or has to reach a certain level depending on the company's size over a period of time. So in general, very broadly speaking, 25% is the minimum shareholding that the promoters have to divest. So as a result, for any new company of a relatively smaller size, 75% will be the promoter holding, which is a reasonably good indicator of the comfort that, okay, if management, if the promoter is comfortable having 75% in the company, then I should also be equally comfortable. At the same time, now if we look at the newer businesses, so a lot of e-commerce, digital and such other businesses are right now in unlisted space. But I'm sure all of you know what is happening is a lot of private equity investors are investing in these companies. And as a result, the promoter shareholding has been consistently going down. By the time they come to public market, possibly depending on the issue size, their pre-issue or post-issue promoter shareholding could be very low in the range of 20 to 30-40%. And there are a lot of existing companies still there in India and in global markets where promoter shareholding is in the range of 20, 30, 40%. So as a result, should we say that we don't have comfort because promoters have only 20%? I don't think that stand can be taken. It will purely, in fact, if at all, one can probably say that the promoters have been too happy to share the wealth creation over the years with other people. So that's the way one can look at it positively. So as I said, it'll come back to the basic analysis of the business model and valuations.
Okay, Kunj, and I thought we would have time for a lot more questions, but indeed it has been a jam-packed show so far, so I'm going to wrap it up. Thank you so much for joining in, and thank you all. You get an A+ for those wonderful questions, and I hope we can do this more often. So with that, I'm sure there were lots of investment ideas that Kunj gave that one should have really taken note of, but with that, it's back to you in the studio.
Well, thanks Avan for that, and clearly a great session with the investors and traders of tomorrow, along with some words of advice, or rather words of wisdom from Kunj Bansal of Centrum, was reiterating the fact that a detailed study be done on the company before investment. Well, let's quickly get a check on the Indian markets as well and find out how we are panning out at this point of time.